Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
Is inflation re-accelerating? Will rise in oil prices push central banks to raise rates further? Is a recession now unlikely? And are markets overvalued? These are the meaty questions we grappled with this episode. As for what's not priced in, recession remains a risk the market continues to underprice at its peril. Hello and welcome back. I think now this is the 17th episode of What's Not Priced In. It's a little bit hard to say these days because you've been making quite a lot of interesting bonus episodes on the topic of net zero. So by the way, if you guys haven't checked those videos out, please do, and there'll be more coming. But Greg, welcome. How are you? I hear Djokovic has won another Grand Slam. How are you feeling?
It was never in doubt, mate. Well, it was a little bit, but
it was with Medvedev. He beat him 2 years ago. So
exactly, and Medvedev played a cracking match against Alcaraz to get there, but I guess he played his grand final in the semi-final. Yeah. So, but more importantly, we got the kickoff of the NFL season, and the Buffalo Bills have started off with a loss against New York Jets. So I wasn't too happy with the start, but long season ahead. So looking forward to that one. While there's a bit of a lull in the tennis, but there's no tennis happening now until I think the Laver Cup in a couple of weeks. Yeah. And then we go into the end of the season, couple of indoor tournaments in Europe, which is always exciting for us tennis buffs. So looking forward to it, mate.
Well, do you think the GOAT debate is settled now?
Well, it should be. I don't think there's any, there's no genuine sort of reason to say that Djokovic doesn't deserve it. I mean, the guy's 36 and he's playing probably better than he's ever played before. Now, generally, most people start to wane a little bit when they get to that age, and old Father Time gives them a tap on the shoulder and says it's probably time to leave. And this guy's getting better, which in tennis to win a Grand Slam, you've got to win 7 matches, best of 5 sets over 2 weeks. Like, there's probably no more grueling sport mentally and physically to be able to do that. And if you're not a tennis fan, you probably don't understand or don't think about that progression over a 2-week period. I actually thought Djokovic might not be a chance, given that he played a very intense final against Alcaraz in the Cincinnati Open, which was just 10 days before. And that was a really, really, tough game of tennis. And often these things take a while to recover from. But he's gone and won a US Open, less than 2 weeks after that, which is just incredible. Speaks to his physical fitness and his mental strength more than anything. So definitely a GOAT from my perspective.
Yeah, and maybe if we can bridge it back to investor, I think I was in his post-match conference, he was sort of saying that he's always trying to eke out gains every year. So he's always trying to improve something in his game. And that's why he's sort of been able to keep ahead of the competition. So for the investors out there,
he's definitely got an edge. He's definitely got an edge.
Yeah, we'll always have to find that edge. Well, maybe bringing it back to more mundane things like inflation. I think obviously we're recording this on a Thursday afternoon, and the latest US inflation data came out. Obviously, we'll focus on the core inflation. Core inflation rose 0.3%, pretty much as expected, and it's now down on an annual basis from 4.7 to 4.3. Obviously, some headlines focused on headline inflation, and that was obviously boosted by rising energy prices. And of course, over the last few weeks, oil has definitely risen, and that has made some people worried that we may see a re-acceleration of inflation in our own fat tail bubble. Some of us have been saying that, is this a risk? Is there a material risk that inflation will re-accelerate, and what will that mean for markets? So maybe we can start off our discussion with that, what you made of it.
Yeah, I think the common view is that rising energy prices equals rising inflation, and there is some truth to that. But I think what you need to do is drill down and look at the monetary aggregates to work out whether there is fuel for that to happen. So the way I sort of think of it is that for a given amount of money supply, if oil prices and energy prices increase, then that takes away and these are essential spending. So you need to fill up your car with petrol to get to work or to travel and get your goods and go to shops and all that sort of stuff. So this is like a very basic level of spending. It's not discretionary.
Yep.
So if you've got $100 in your pocket each week for that, and your fuel bill goes from $50 to $70, then your leftover spending has gone from 50 to 30. So it's actually deflationary in many ways. Now, if you can't pass on, if you can't go to your employer and say, I need more money, if employers can't pass on the higher costs of transport, all those sorts of things, then it's going to show up in less demand. It's going to show up in margins contracting. So I think the common refrain at the moment is that our energy prices are rising again, and there's many reasons for that. And this is why we've talked about, you mentioned at the very start, the interviews that we've been doing on the net zero insanity stuff, is that we are making it very difficult to get new supply of traditional fossil fuels onto the market. At the same time as we're trying to electrify our grid, and we're not replacing, say, coal-fired power stations with the requisite amount of renewables we need. And when we are adding renewables, they are very intermittent and less reliable. So we are creating a situation where higher energy prices over time are not certain, because nothing's certain, but are becoming a higher and higher probability. So energy prices, in my view, will continue to rise. Now, clearly we're going to have corrections along the way, but I think, and we'll show you a chart later, the Brent crude and the international oil benchmarks are breaking out from their corrections that they experienced throughout 2022 and 2023 and are now starting to look really, really bullish. But does that mean we're going to get another inflationary breakout? I don't think so. And I want to show some charts to explain why, because as I said, this is it's an important thing to understand. So let me just show you what I mean. So let me know if this chart, you can see this chart. It's a Fred chart from the St. Louis, I think it's the St. Louis Board of the Federal Reserve.
Yep, I can see it now.
It shows M2, which is I guess a basic money supply aggregate, and that's in the green. And then it shows different types of it's called personal consumption expenditures, but they're different types of inflationary indicators in the US. So the one thing to notice here is that M2 shot up in response to the COVID stimulus, and the gauge for that is on the left-hand side, and you can see that it says percent change from a year ago. So M2 was growing at a rate of over 25% in probably around late 2020, early 2021. Now, we often wouldn't be an episode of What's Not Priced In without talking about the lags of monetary policy.
We should have a live track every time you mention it.
Exactly. So it goes without saying that we're seeing those lags in this chart, and the lagged effect of inflation. Inflation flows through to the system. I'm not exactly sure. I didn't have the detail of this chart to see what the exact lag was, but let's say it's looking at about 12 months or so, maybe 18 months of when inflation peaked to when the growth in M2 peaked. Now, you can see that M2 has come down very, very sharply in this chart. It's gone from 25% annual growth to now negative growth. And just to give you another read on that, I got this from the Mises Institute. They have an indicator called the true money supply, which is even running at a more negative level. It includes a few other things that standard M2 readings don't. But as you can see, the monetary aggregates, thanks to monetary tightening over the past 12 months, or a little bit more than 12 months now, has really come down, and it's down into negative levels, which virtually never happens.
Yeah.
So going back to this chart here, what the people who are saying higher energy prices are going to translate into higher inflation
Yeah.
are suggesting that these inflation indicators are going to continue to go up. But my argument is, if M2 stays in a contractionary mode, or year over year negative growth, or at least year over year very low growth, it's very hard to get a reacceleration, a sustainable reacceleration of inflation. And I think the greater risk here is that higher energy prices are going to subtract from discretionary spending and make it even, I guess, put more pressure on consumer demand, because you're going to get a situation where interest rates are staying high, and the Federal Reserve especially, and even our Reserve Bank will be concerned about the rising cost of energy, and they're going to say, okay, well, we keep interest rates high because we don't want to stoke the demand for that, and fair enough. So you're going to have higher interest rates, or staying higher for longer, higher energy prices, which are going to act as a constraint, another constraint on demand. And I think that will continue to put downward pressure on inflation, especially core inflation. So obviously headline inflation will still be impacted by the energy numbers, but the central banks will look at those core numbers, and I think that those core numbers will continue to come down. The other thing just to point out here, this is bank credit by all commercial banks in the US, and then that's now running year over year negative, which very, very rarely happens. It only happened here back in the 2008 credit crunch. So there's a couple of ways that money is created and gets into the financial system and into the economy, and that's through banks creating credit. And banks are clearly not creating credit. Credit growth is running year on year negative at the moment. So, and the last one, just to show here to give you another indication of that there's no sort of inflationary impulse, is that you've got Federal Reserve. This is the Federal Reserve bank credit that's running negative on a year over year basis as well. So this huge spurt here was post-COVID. The inflationary breakout that we saw was in response to this, in the same way that we saw a COVID sort of really high rate of bank credit growth and the money supply. So all these things contributed to the high inflation we've got now. But inflation, we often say, is a lagging economic indicator, and you're going to see, in my view, inflation continuing to come down in response to these fall in the monetary aggregates, and that's despite what I'll just stop sharing. Despite what people might think about higher energy prices, I just think that you need money supply growth in order to fuel higher prices, and the ability of companies to pass on higher costs. And we've seen that in the past 12 months. Companies have been able to pass on higher costs, and that's why we've seen the inflation. But we've talked about in previous episodes how people's excess savings are starting to run out. So I think people's ability to absorb those cost increases has been made easier by the fact that they've had excess savings, and they've just they've said, okay, well, I've got the money to continue to pay for those higher costs. Companies everywhere, insurers especially. I mean, if you've had an insurance bill recently, the amount that they've passed on in terms of higher costs, and people simply have to absorb it, because if you've got 3 different insurers all putting up their prices by 10 and 20%, there's not much you can do about it. But it'll get to a point soon where these savings are starting to run down, and we saw it in last week's national accounts. I think the saving rate is now down in Australia. I think it went from, don't know the exact number, I think it went from 3.7 to 3.4% to its lowest point since June 2008. So there's not a lot of savings left for people to continue to pay for companies rebuilding margins. So I wonder whether companies will continue to be able to pass on price increases, and quite possibly they will now have to start to sacrifice margins in order to keep the demand side going. So
yeah, and I don't think it's ever as simple as oil prices are going up, therefore headline inflation is going to reaccelerate here. I think I was sort of reading from the RBA's research bulletins, and they sort of linked out to this research paper in their own internal team that sort of tried to model inflation risks and inflation drivers, and they've found that if you focus on oil, it's too much of a noisy indicator for where inflation is going. And they did some regression and analyses, and they just found that it's just too hard to predict where inflation is heading based on oil prices, and it's never a massive proportion to the CPI, the oil prices. So just because all of the news headlines sort of focus on oil is rising, and therefore we might see a reacceleration inflation, may not necessarily be true. And like you were saying, it's just so much more complicated. The global economies are so intertwined, and there's all of these different interactions. So just focusing on one factor is just probably oversimplified.
And the other thing to take into account as well, I think, is that there's two ways that you can interpret rising energy prices and rising oil prices. One is that in an expanding economy, you've got increased demand, and that is driving the price higher. The other, and I think this is partly behind, probably more behind the recent run up in prices, and I think will continue to support prices in the years to come, is the supply side of the equation. So we're in a situation now where supply is very constrained. You're not getting capital expenditure into new exploration. We're not finding significantly new oil fields or energy supplies in order to continue catching up or meeting demand. And I think demand, I read somewhere recently that demand is at record highs in terms of 100 million barrels a day, which is up there with the peak. So demand's still strong. You got supply constraints, and that is forcing prices up. So, I mean, even just a situation where everyone who's listening to this will go, who fills up at the petrol station knows that petrol prices in Australia didn't go down with the oil price. I mean, that went down a little bit, but we are still paying a lot for the petrol prices, and part of the reason is we just don't have any refining capacity in Australia. We've got 2 refineries here where we used to have 4 or 5 a few years ago. We import probably 75% of our refined fuels from places in Southeast Asia and Singapore, Korea, stuff like that. And the problem is, and this is why I keep banging on about this net zero stuff, is that when Western leaders have these policies that are all about going green, no one is going to spend the billions of dollars that are needed on new refining capacity. I mean, maybe they'll do it in India or China because that is integral to their growing economies, and they need to do that. But they're going to look after their own economies first and export any surplus that we may need. But you're certainly not going to get those investments in the US. You're not going to get them in Australia. But our economy, if we're still going to grow, we're going to need that refined fuel. We're not all going to be able to, park our cars in garages and charge them up in the middle of the day from the sun. Like, it's just not going to happen. Yet that's essentially what our longer term plan is for our energy needs. So you're seeing rising petrol prices are not happening because of increased demand. They're happening because of supply constraints, and that we're not building more capacity to get prices down. And that's part of the problem. So it's not necessarily going to feed into inflation, but it will feed into more pressure on the consumer, and more less capacity to spend.
Yeah. Well, speaking on pressures on the consumer, I thought we could maybe pivot and talk about maybe recent things that I've seen from forecasters and other central banks and even hedge fund managers that sort of think that I think the market overall is now positioning to this stance that there probably is not going to be a recession, and the central banks in Australia and the US and other advanced economies will probably pull off a soft landing. And I think recently, I'm just going to read out some things that I've noticed in the media. So there was a Bank of America monthly survey, and it found, I think in August, that 6 out of 10 fund managers think that the Fed is done lifting rates. And in July, it was 9 out of 10 were saying that the Fed is not yet done. So that's quite a big change in quite a short amount of time. But on the other hand, also, there's less worries about the economy from businesses themselves. So I think only 62 companies in the S&P 500 cited recession in earnings calls from June 15th through to the end of August. And that was down from 113 during the previous reporting period and well below the peak of 238 in the summer of 2022. So businesses are citing recessions less and less. Fund managers think that the Fed is done hiking rates. Over in Australia, the mood is similarly buoyant. I think you sort of tweeted this out. I think earlier today there was an article from the Australian Financial Review where I think Westpac chief executive and the NAB chief executive both said that they don't think a recession in Australia is likely and that things are softening, but not so much that it's going to be to a dangerous degree. And I think the National Australia Bank chief executive, Ross McEwen, said yesterday, we just don't see that there will be a recession in Australia. It's just quiet at the moment. But we do need a lot more on productivity. So what do you make of that?
Well, they're probably fair comments, but to be honest, I don't think I've ever heard a bank CEO say that they think a recession's likely or coming. That's just not what they do.
Yep.
But it's fair comments. I'm just trying to think of the actual numbers. The GDP numbers came out last week for the year and the 3 months to June 30th. If you subtract the export sector or the I guess the mining sector essentially, then the domestic economy went backwards. Nominal GDP contracted in the June quarter. So we are in recessionary-like conditions. But thanks to the volume of exports and the still good prices that we're getting, that's helping the overall GDP numbers. So. And so that has to be taken into account. The fact that the Australian mining sector is so strong is definitely something that will generate enough national income to probably keep us out of recession. And if you look at the Aussie yield curve, it inverted slightly a few months ago, and then it uninverted. So it was getting to that point where it was thinking, we might get a slowdown, but so. The comments are fair. Like, it is quiet, and I think there are certain parts of the economy that are definitely recessionary. What you're not seeing...
technically, I think some people would say we're in a per capita recession where
and just to explain that, we've got pretty strong population growth, which boosts up the headline number. But when you divide the growth by the increase in population on a per capita basis, things are looking a bit rough. I'd agree with that. But going back to your initial comments about what people are saying and what they're thinking, I mean, this is part of the reason why we do this podcast. We try to sort of look beyond the headlines and try to get an understanding of why these surveys are saying what they're saying. And the old saying is that markets make opinion, and if the stock market is telling you a certain something, then you tend to believe it, and you just say, okay, well, the stock market hasn't really corrected, or the stock market's telling us that things are pretty strong, so therefore let's go for the soft landing option, or let's go for the it's not going to be as bad as expected option, which is completely understandable. But the point is, I think we're in probably a transition phase, and we've talked about this before, in that a lot of people are scratching their heads as to why this big increase in monetary policy hasn't really done as much as what people would have probably expected, given the huge increases in rates in both the US and Australia. Why hasn't that had an effect? And it goes back to the fiscal side of things. There was a huge fiscal stimulus around that time as well, and that takes time and has taken time to work its way through the economy. So we talked, I think 2 weeks ago on this podcast, that the US, there was some data out from the San Francisco Fed that said the US consumer or household sector was pretty much going to be out of excess savings by the end of this month. So going into the last quarter of this year is going to be interesting in terms of the ability of the consumer to keep spending. And I think that's been, and in saying that, the labor market to remain strong as well. So that would be my my query over whether this soft landing plays out. And then there was a really interesting comment that I'm a fan of Dave Rosenberg, who I subscribe to. He's very experienced economist. He's been around for a long time. And he's a real contrarian. Like he's not swayed by consensus opinion, really sort of looks at the data, looks at the detail. So I pulled out a quote from his research. It's a fair bit of words on here, so I'll just read through it. But I thought this was really interesting. And it says, and for those who don't see a recession, just remember the traditional lag from the Fed's first volley to the time of the recession historically was not 22 minutes, 22 hours, 22 days, or 22 weeks, more like 22 months. That puts Q4 of this year or Q1 of next year in play. All soft landings, and they can easily last a year, think 1989, 2000, or 2007, are bridges from the expansion to the contraction phase of the cycle. They are a transition period, and they are not permanent. Either the economy somehow reaccelerates with looming fiscal tightening and the lagged impact from the Fed in terms of what still lies ahead makes that unlikely, or it downshifts into recession. Then he just says soft landings don't hang around to perpetuity, and the only 3 times the Fed did pull off a soft landing in the post-World War II era, in the mid-60s, the mid-80s, and the mid-90s, was when it stopped tightening once the yield curve looked poised to invert. This Volcker-esque Fed felt the need to keep on going, not just keep on going after the curve inverted, but hiked 75 basis points after the 3 regional bank failures last winter. So basically he's saying there's no such thing as a soft landing. The soft landing is effectively a transition from growth to recession. And Dave Rosenberg reckons we'll be in recession in the fourth quarter of this year or the first quarter of next year. And if we're not, I think he said he's going to admit that the business cycle doesn't exist anymore. So just while I'm on this screen, I just wanted to show you another chart that sort of talks or puts another slant on the transition period. This is a timeline of the CNN Fear and Greed Index, which we often talk about on this show. Now, we sort of had this up showing in June and July, the CNN Fear and Greed indicator was in constant extreme greed phase. And we're sort of talking about how, that was a sign that markets were overstretched. There was a lot of momentum, a lot of fear of missing out. And this was one of the longest periods of extreme greed that I can remember seeing in this indicator. But since then, it's dropped and it dipped into fear mode, and it's bumped up, and it's now in neutral mode. So if we're talking about a transition period that we're in now and perhaps moving into in the final quarter of the year, then my view is that we could be going from extreme fear here down into neutral, and then potentially down into an extreme greed. I think I got that mixed up. Extreme greed up here, down into neutral, into extreme fear down here as the next few months unfold. Could be completely wrong about that, and not sort of saying that's a prediction. I'm just suggesting that is quite possible given the scenario David Rosenberg's pointed out. And maybe we can also talk a bit about what the stock market's priced in and what the valuations are at the moment, because that's certainly not on the cards, I don't think.
Yeah, I think we should definitely. I was going to ask, given that Rosenberg's quote, and then I think maybe the market is definitely a bit more optimistic than what, for example, someone like Rosenberg would think. So clearly, do you think the market is not pricing in the threat of recession highly enough?
Absolutely not. Again, if you look at the S&P 500 forward estimates, which I looked at earlier this week, it's on a PE of, I think it was 18.75 times, which equates to an earnings yield of, write it down here, 5.33%. So what that means is when you're buying the S&P 500 here, based on these forward earnings expectations, which, by the way, are forecast to grow in 2024, 12% on 2023 numbers. So the market's actually thinking the consensus numbers are predicting earnings per share increases next year, and you're trading on 18 times, nearly 19 times forward estimates, which is an earnings yield of 5.33%. Now, if you compare that to the 10-year bond yield, which is a bit of a proxy for the risk-free rate, which is 4.3%, you're getting 1% equity risk premium, which is very, very skinny, and it's not offering any. It's offering virtually no additional reward for the risk taken. So, in my mind, the stock market is very overvalued. If that scenario of slower growth, and by the way, the higher energy prices feed into that negative outlook. If energy prices are rising because of supply constraints and not because of demand, then that's a negative. Rising energy prices absorb market liquidity because the oil market is such a huge market. If you want to any liquidity that's in the market that needs to be devoted to buying, storing, trading oil, it's going to soak up more liquidity than previously at $90 or $100 a barrel than it did at 70. So all these things are not necessarily bullish for the market. So, risk and reward, I just think the market is all risk and no reward at this point.
Yeah. And I think, for example, you were saying you didn't want to make a recession prediction, but in these situations, you don't even necessarily have to, because like you said, it's all about just seeing where the risk lies in terms of reward. So clearly the market is maybe pricing in a probability for recession that's too low for you, and therefore with how expensive the market is right now, it just doesn't really make sense because the reward just isn't there given the risk. So you don't necessarily have to just make a hardline prediction and really stand by it. It's just more just assessing where the risks lie. And right now,
it's not as if you're sitting around on the sideline waiting for a recession before you invest. And as we often point out, it's a market of stocks, not a stock market, and there's always individual opportunities which are priced a lot more attractively than the market in general. So I'm not saying that you should be out of the market waiting for this recession to hit. All I'm saying that on a general sense or as a general call, given where the risks lie, the market is not pricing those in. So what's not priced in is a slowdown that is more likely than what the market is expecting. So, it's just a matter of keeping some powder dry, making sure that if that scenario does play out, then you're in a position to take advantage of it. And one thing I want to sort of look at when you're thinking about taking advantage of stuff is sentiment indicators, and when sentiment gets quite low, that's when you can get some pretty good opportunities.
Yeah. And what do you measure? What indicators do you use to sort of figure out if sentiment is too low or too extreme?
Whole bunch of stuff. I mean, we would look at magazine indicators at that time. You'd look at CNN Fear and Greed Index, the Investors Intelligence readings, which come out every week, newspaper headlines, general vibe of, just the way that, and that's one of the things that I try to do when things get really scary is you try to detach yourself from that emotion and just try to really dispassionately look at a whole bunch of different indicators and say, okay, well, it's like you want to try and stand above it rather than be involved in it, because when you're really in the midst of it, it's very hard to rationally assess where you are in the situation. And we're not there yet. And I think the CNN Fear and Greed is a good indicator. We're in a neutral phase. We're in a phase, and let's just have a look at our market, right? Like the ASX 200 has literally just done nothing. Like it's just going up and down and up and down and up and down, and it's almost lulling people into this false sense of, maybe it's not even a false sense, but just people are sort of dying of boredom out there. It's just the market is just not really offering anything at all. It's very trendless. And generally the way these things resolve themselves is that they break up out of the range, or they break down, or maybe it just continues going sideways for some time. But when you sort of really look at this from a longer term perspective, like I've just really outlined the trend over the last, let's say, nearly a year. This is going back to November last year, or here just when we broke up, early November last year. So we're not too far away from just a year of sideways. But we go back to this point, this is 12th of August 2021, where the market hit a high, and we haven't revisited that. So we've just been in this long sideways move. Now, my sort of feeling is that we could revisit these lows in the months ahead, especially if the US economy unfolds the way I think it might. In which case, I think that'd be, interesting buying territory around there. I think you get a lot of panic, and you'd have a lot of people that have probably bought and accumulated around here, panic and give up and just get out of the market. I had a quick look at the small ords, and I thought this was an interesting little development on this chart as well. The small ords have underperformed the ASX 200. I'll just pull this back a little bit. So this is where the peak of the markets were in, 2021? Big correction. It really hasn't rebounded, and this consolidation has been in a wedge formation, and often these things resolve themselves by breaking up or down as well. Early stages, this might reverse in the next few days, but it's just worth noting that it is starting to get a little bit of pressure on the downside here and is breaking down. Is that a leading indicator for the bigger stocks? Don't really know, but it has been difficult for the smaller end of the market. And when you look at the small ords relative to the ASX 200, you can just see that's just, the bigger stocks have outperformed the smaller stocks. So I do think, and I read this a lot, people are saying that there's value in the small caps and that's where the opportunities are. I've no doubt that's the case. I guess the question is, how much lower do they go, and when does the outperformance start? And from my perspective, you don't want to take that bet too early, but it is worth looking at or keeping an eye on. Just some other things while we're on the charts, I thought we could look at. This was the chart of the oil price that I mentioned earlier. So it came. Let me just pull this back a little bit. So you can see here, this line is a reasonably important support resistance line over the years. And it corrected right back down, and it always found buying support coming in just above there. And now we're sort of starting to trend higher again and pulling away. Just to be cautious though, in the short term, it is overbought. So this is a short-term momentum indicator. It is getting up towards the 80 level, which traditionally suggests that, prices are overbought and a correction is probably not far away. So, but from a longer term perspective, the oil market looks really, really strong there. The other thing I just wanted to point out, we do look at this each week or often. This is TIPS, which is the inverse of the real interest rate. So real interest rates are effectively back at those highs of where they were last year. Now, that is clearly going to be contractionary or difficult for an economy to grow when you've got real interest rates this high. They haven't been this high for over a decade, and there's a lot more debt in the economy. So there is a fair bit of pain in this level of real interest rates. Now, the reason why that pain hasn't been reflected in the economy, as we talked about, was the lingering stimulus effects from the fiscal policy. But if we're correct in thinking that really starts to leak out of the economy in the final quarter and into next year, then these high real rates are going to play a much bigger role, which brings me to, I guess, my main point of what's not priced in. I remember months ago we were saying the higher for longer interest rate regime, that's what central banks are going to be looking at doing. And now that's become almost a consensus view, right? Higher for longer. Everyone's talking about it because of this feeling of sticky inflation, because of energy prices. And everyone thinks, okay, well, the Fed's going to keep rates higher for longer. My feeling is that whenever anything becomes consensus, you have to start thinking, okay, what's another explanation? Because consensus never really lasts for long. Consensus always shifts to another consensus. And the idea is to try to be ahead of that consensus. So my feeling is that if we're right about this lack of fiscal stimulus, still high monetary policy, the lagged impacts of it is going to send inflation lower, and it's going to force the Fed to cut sooner than what the market currently thinks. So the higher for longer will be, oh shit, there's a recession, we got to cut rates, and we've got to cut rates pretty quickly. And what are we? We're sort of mid-September at the moment.
Yep.
Let's give it maybe 2 months to 3 months and see whether that view starts to shift, because these things do take time. But that would be one non-consensus view, what's not priced in view, that I think people should really start to be considering. How do you take advantage of that? Well, let's look at the gold price, because gold often moves in ways that are opposite to real interest rates. Now, gold's actually in a bit of a stealth bull market here. It bottomed last year. It's rallied. It's pulled back. No one's really interested in gold. You very rarely read about it. You very rarely hear about it. But it's just doing a nice little consolidation correction period here. What I'd like to see is a higher low, and then the next rally take it above this level here. If you saw that, that would suggest to me that maybe real interest rates are bottoming, and that's going to provide a boost for the gold price and gold stocks. And the other thing, which we pointed out before, this is the BlackRock Australia iShares Core Composite Bond ETF, which is a bloody mouthful. But it's effectively a bond ETF, right? And it's been bottoming for over a year now. And this is a really, really solid base for whether this is a bond fund or a stock, doesn't really matter. As a charting picture, it looks like a solid base for this to start moving higher. It would only move higher in a recession / falling interest rate / not higher for longer environment. So it's still early days in this. Like you're seeing a big double low here, another sort of higher low being formed here. But I think if these prices can sort of maintain around these levels, move above these moving averages, then that's a good way to play the, I guess, maybe coming recession and not higher for longer, maybe lower for longer interest rate regime. So that's just a few thoughts on what's not priced in and what people can maybe start to think about unfolding over the next 3 months.
Yeah. Well, if you would indulge me, I actually have something that I think the market isn't really pricing in as well.
Let's hear it.
Okay. Well, I think, for example, we said that some people think that the threat to inflation reaccelerating right now is energy or oil prices. I think the biggest threat that's not really being priced in is productivity. And I think I mentioned this on a business call last week, I think, and didn't really get the reception that I was hoping for. But I mean,
I'm shocked. I mean, productivity is normally such a
interesting
it's a party
topic.
starter.
Well, and I think all of the central banks and the research teams in the central banks, I think for the last year, they've sort of been dropping hints that they're worried about productivity and they want productivity to pick up. And I think Philip Lowe, who's now probably, I think, is he officially now no longer the governor?
Yeah, I think he's out the door.
Yeah, I think so.
So he's probably going to start talking the truth now.
Yeah, exactly. And I think in his monthly statements after the policy decisions have been made by the Reserve Bank, Philip Lowe always said that wages growth has picked up over the past year, but it's still consistent with the inflation target, provided that productivity growth picks up. So he always hammered home that point that productivity has to pick up if we should be content with inflation. But productivity clearly has not been picking up. In fact, it's been dropping. So I think the latest ABS figures for this year, so we've worked 6.8% more hours this year than last year, but labor productivity actually fell 3.2% in annual terms. So that's pretty bad. GDP per hour worked fell 2% in the June quarter alone and is now down 3.6% year on year. And that brings me to this really interesting and exciting term called unit labor costs. And it sort of basically measures how expensive labor is based on productivity. So you don't really want to see unit labor costs going up because that pushes up services inflation. And clearly, while goods inflation has been coming down this year, services inflation has been the one that's remained sticky. And that's the one that central banks are worried about. And that's affected by unit labor costs. And that's been rising recently because productivity has been either down or flat. And I think, the ABA said that real unit labor costs rose 3.2% in the June quarter and are now up 5.8% for the year. And that's not really good news at all, because I think Philip Lowe said in a committee hearing, I think a few months ago, that if we're going to have 2.5% inflation, we cannot have unit labor costs persistently growing at 3.5 to 4%. And then he said, we have to have labor cost growth starting with a 2, and clearly our current labor growth cost does not start with a 2, it starts with a 5. So
well, let me ask you this, Kirill.
Yep.
If unit labor costs are growing, i.e. the productivity of labor is weak, what happens to the labor market in a slowdown?
Well, I think obviously one way to do that, I think Philip Lowe was sort of saying we either have to increase our productivity quite a bit, and I think historically, even before the pandemic, Australia's productivity has been either flat or pretty disappointing, or obviously wages, I mean, not wages, but hours worked have to come down, and that sometimes
job
obviously
losses.
Yeah, exactly. And
Which is my point in many ways, that the way that these things get resolved, because productivity, you just don't flick a switch and become more productive. Productivity is one of those really tricky things that no one really knows how to sort of produce it, but it comes from investing in new technology. It comes from having good education systems that develop smart thinking, productive people as they move into the workforce. There's a lot of longer term intangible things that all produce productivity. So you could argue over the last 10 or 15 years that maybe we've dropped the ball on that massively. So you're not going to improve productivity immediately from those things, but you can improve it by cutting your amount of workers if you can manage to still get things done with less hours worked and with less people working. And that sounds like a pretty callous way to talk about it, but I think that's what I'm getting at here, is that if we don't have all the fiscal stimulus that's providing the demand and keeping people employed because that demand is still there, that will flow through into a higher unemployment rate. And companies that are dealing with low productivity, one of the few ways that you can quickly deal with it is to cut the number of people that are working with you, working for you. So this, I guess, says the same thing. We're looking at a potential slowdown coming for these reasons.
Yeah, and I think obviously at the moment with the labor data, it's obviously a lagging indicator. I think today the ABS released its latest employment figures. I think unemployment is still at 3.7%, so it remained the same month on month. But I think the ABS did say that the labor participation rate rose a little bit, and that it's at a record high. So it's something has to give. Either productivity has to rise somehow, or I think businesses with rising costs might have to start cutting hours worked.
Well, let's check in on that in 3 months as well. I'll be tipping higher unemployment. Could be completely wrong, but see how we go. Put in your diary. What are we? 15th of let's say just before Christmas, roughly the 14th of December.
Happy Christmas.
Yeah, exactly. We'll check in on that.
Yeah. Well, I think, did you see that on the topic of productivity? I think there was a property developer, Tim something. He was
Tim Gurner.
He's gone global. Yeah, he's gone global.
He
for
has.
saying that employees should respect their employers more often, and that there should be more pain in the economy. Yeah,
I mean, talk about not reading the room. Some people just say the quiet bit out loud in front of a big audience. So yeah, I don't really know what to say about that. But in an environment where we've gone through cost of living crisis, and to have someone who's clearly not in any way bothered by current cost of living issues say that we need more pain, it's just dumb. It's just dumb.
Yeah. And I think he definitely hit a nerve, because it's gone global. I think American politicians have been subtweeting him. So I get, maybe for him, bad publicity is good publicity. Who knows?
Wouldn't have thought so, but you never know.
He maybe have called for pain in the economy, but he's certainly inflicted pain on himself. So maybe he's halfway there already. Yeah,
absolutely.
Well, I think with that said, we can maybe wrap up the episode. I think this was a great one. Lots of ideas that are sort of what's not priced in, goes down to the ethos. So thanks, Greg, for that. And
Absolutely. No worries.
catch you next week.
Thanks for listening. Share.
Oh, yep. Share.
What's your share, like,
please,
subscribe,
please like, share, and subscribe, and leave the comments down below.
That's it.
Yeah.
All right. No worries. Thanks, mate. Thanks everyone
Awesome.
for watching and listening.
Thank you. See ya. Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing, and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.